Hello, in this video we'll talk about annuities and we'll focus our discussion through an annuity problem. Grape purchased an annuity policy at a total cost of $18,000. This is the amount that Grape actually paid for the policy. Now starting on January 1st, year one, so immediately the next year, she begins to receive an annual payment of $1,500 per year, so total for the year, for the rest of her life. Now her life expectancy as of January 1st, year one is 16 years. We have a few questions we need to address, but we're going to focus on them in order to again, go through the understanding of how annuities are taxed from an income tax standpoint. How much annuity income must be included in Grape's gross income? And we're focusing on year one, when Grape actually receives the $1,500 total for that year. Whenever we have an income tax issue, we always address 5 questions. The first question is, what amount of income from any inflows? And here, Grape does have an inflow, the $1,500 received. What about deductions? What amount of deduction or credit? And this usually deals with outflows. Now, you might be thinking, well, I don't see any outflows here because Grape is paying for $18,000 before, but we're looking at year one. And at first blush, you're right, there is no outflows, but we could still have a deduction. You'll notice when we talk our discussion later on. The third question is when. When do these respective tax consequences take place on the tax return? The fourth question is who. Who has to report these transactions or these tax consequences? And here we're only dealing with Grape, so it's going to be Grape. The fifth question is a character question. The character of any income, deductions of the above issues. Now, we're not going to focus on character in this discussion, but I will tell you, for those of you interested, the character will be ordinary. The characterization issue will be something later on discussed in another topic. So now that we have our 5 questions, we need to focus on what amount of income, because again, Grape does have an inflow of $1,500 for the year. And we're specifically looking at year one with respect to our initial discussion. And I'll talk more about other years beyond, as well as the other questions will focus on other years when different things happen. But we're going to focus on year one, the initial year. So if you remember, when we talk about gross income is defined in the tax code to be income from whatever source derived. Very broad. And we look at the Supreme Court, the Glenshaw class decision, which says that gross income is when a taxpayer has an accession to wealth, which means the net worth goes up, clearly realized, and there's complete dominion and control. Well, we need to figure out what exactly are we looking at here with an annuity. So the first thing to understand is what exactly is an annuity? What is it made up of? So an annuity for tax purposes is any payment that is going to be beyond 1 tax year. So greater than 1 tax year, the payment. That's very important. So if you have 2 payments over 2 tax years, then it's considered an annuity for tax purposes, and it potentially is subject to the rules we're going to talk about, which are specific tax rules. Now, what exactly is an annuity? What's going on here? Well, think about this. And you got to think about what exactly is going on. So Grape is paying $18,000 for this policy. $18,000 for the policy and paying for that before year one. And then Grape is going to get this payment of $1,500 per year for the rest of Grape's life. Now, based on some actuarial tables, and the IRS provides these, but they're provided by various government agencies, Grape has a life expectancy of 18 years. So if we go by by 16 years, not 18 years, 16 years. Sorry, it's 16 years. If we go by those 16 years and we take $1,500 per year times 16 years, we get $24,000. So the difference between the 24 and the 18, that $6,000 difference, that can be viewed as some type of earnings, like interest, dividends, or some type of similar passive income. Something like that, okay? So the annuity is made up of this cost. It's the cost over the time, and also this $18,000 cost, and also this $6,000 difference. So there is the cost portion, which the annuity, we're looking at a per year amount. And then there's also this earnings portion. Now, if you received interest or dividends, it's pretty clear that that would be gross income. If you go through the definition of income, it's extremely clear that when you receive interest or dividends, that is including gross income. So if we determine that a portion of the annuity payment each year is earnings, then it makes sense that that portion is included in gross income. But what about the cost? Should Grape have to record the portion, that $18,000 paid, every year as income? And the answer is no. It's a recovery of capital concept. Recovery of initial capital. It's like if you purchase stock and you sold the stock later on, should you be taxed on that stock what you paid for it? And the answer is, from a tax standpoint, is no, because the idea is there's multiple reasons, but you've already put in that investment. It's already been taxed in a way. So we have this idea called basis, which is really recovery of capital. The idea is recovery of capital. It's that $18,000 cost, that portion. And that portion is not going to be taxable. Not taxable. It's not part of gross income. The earnings, though, are taxable. They are taxable in gross income. Okay? So it's important, again, to understand what exactly is going on. There's this $1,500 annuity payment each year. A portion of that can be viewed as costs, and a portion of that can be viewed as earnings, potentially. We have to talk about the possibilities of how the tax law can actually account for this. Because one year it might be all costs, one year it might be earnings, based on what the possibilities are. I'm going to give you what the rule is, but I want to first show you what the possibilities are out there for how this could be treated. So there's really two main possibilities of how the tax law could treat what's going on with this $1,500 annuity amount. So we have this $1,500, which is the amount of the annuity per month, and the question becomes, how are we going to break that up? How is that going to be broken up as costs and earnings, that portion? And again, how do we treat that for tax purposes? So the first possibility is, and this is really an ordering. It's an ordering rule. Because again, if it's all viewed as cost or all viewed as earnings, it makes a difference. One's taxable, one's not taxable to Grape. Well, the first option is that let's first allow all payments to be recovery of capital until $18,000 is reached. So what am I saying here? There's an $18,000 total cost, right? Every year, Grape is going to get $1,500 for the rest of Grape's life. So if you think about it, years 1, 2, 3, 4, 5, 6, if you keep going, you won't get up to $18,000 until you get to year 12. If you take $1,500 times 12, you get $18,000. So years 1 through 12 would not be taxable. And then everything after that, years 13 through 16, those 4 years would equal $6,000, and those would be taxable. That's one approach. You could order it so that first the cost comes out, which the years 1 through 12 would not be taxable. So the second possibility is the opposite of possibility number 1, in which the income comes first. The earnings are first, and the cost recovery is after. Remember, cost recovery portion is the non-taxable portion. The problem with that is if you look at this annuity, it's based on life. So at what point would it switch? So option number 2 really makes no sense to do it this way. So really, option number 1 right now makes the most sense. And you would think, okay, well, let's go ahead and do that. Let's give the taxpayer the benefit of the doubt and go ahead and use the $18,000 first, and then whatever is left is going to be taxable. The problem with that approach is economically, if you really think about an annuity, again, a portion of that is, again, the costs and the earnings. So the government takes kind of like a middle approach. And this middle approach is the actual rule. And it's basically a pro rata approach. It's a pro rata approach to this issue. And again, what it does is it breaks up each annuity payment each year into a non-taxable and a taxable portion. We use what's called the exclusion ratio. the exclusion ratio. The exclusion ratio is the total cost at the beginning over the total estimated payments using the remaining years, or the life expectancy. Or if it's a fixed number, you know how much is going to get paid, 10 years, you use that. Okay? So that's the formula, total cost over total estimated payments. So if we actually calculate that out, again, the total cost, which here is $18,000, we're given that cost, $18,000, over the total payments that are expected. So we take $1,500 per year times 16 years. That gives us $18,000 over $24,000. This equals 75%. So what we're saying is that 75% of $1,500 is excluded. It's considered cost non-taxable. So if we go ahead and do that, $1,500 times 0.75 equals $1,125. $1,125. So of the $1,500, $1,125 in year one will be not taxable. And then the remaining portion, $1,500 minus $1,125, is $375, will be taxable. So that means in year one, GRAPE has to include $375. $375 is included in GRAPE's gross income. That's how this works. That's the rule. We use the exclusion ratio. And this calculates the portion that is excluded, and then you subtract away the portion that is included in GRAPE's income. Now, this is the actual approach that is in the tax law. There's what's called a simplified method, which the IRS allows, which is more of like it's a similar approach, but it's rounded, and it just simply uses some, kind of like a formula to calculate. Use kind of multiply type thing, and they give you some factors. Okay, this is the actual approach. The actual approach. Now, if you think about it, and you look at the life of the annuity, right? If we go through each year, so this is, sorry, it doesn't equal out, right? They're not exactly equal, but this is 16 years. So each year, you're going to have $1,125, which is the portion that's not taxable, and then $375 is taxable. If you took $1,125 over those 16 years, that would add up, if you add it up for each year, would be $18,000. If you added up the $375 each year for the 16 years, you would get $6,000. $375 times 16 is $6,000, which remember we saw was the difference between the $18,000 and the $24,000 expected amount. So if GRAPE gets payments from years 1 through 16, then that's going to be the same amount for each year. All right. Now, before we look at what happens if GRAPE dies during, in between those 16 years, or what if GRAPE outlives the 16 years, before we do that, I want to just draw your attention to, again, that first option. Is this better for the taxpayer than the first option where GRAPE is allowed to recover the tax benefit, the cost portion first, so all payments up to years 12 are not taxable, and then everything after that is taxable? Is this approach better? The answer is no. Taxpayers that have income inclusion want to defer income. They want to defer income. And the reason is time value of money. If you can defer income to years 13, 14, 15, 16, then that's better than paying a little bit in years 1 through 12, which is what, and through 13, 14, 15, and 16, which is what goes on here. Okay? The idea is that with the time value of money, $1 of tax savings today is worth more than $1 of tax savings in the future. Because $1 today is worth more than $1 in the future. That's $1 you get back, or $1 you don't have to pay the government. That's the idea. So almost always the taxpayer prefer. But unfortunately, again, the tax law is we use a pro rata formula-based approach where each year a portion of that $1,500 is taxable. So now let's go on and say, okay, we have these 16 years. What happens if GRAPE dies after GRAPE receives 10 annuity payments? So let's say that GRAPE dies after receiving only 10 annuity payments. So GRAPE dies in year 10. All right? So if Grape dies in year 10, then what happens is, well, if you go through and you calculate, it's not going to equal $18,000 of cost recovery. And again, Grape should be able to recover all $18,000. If you actually do 10 payments, so we have $1,500 times 10 years, Grape collects $15,000. So Grape didn't get to collect all $24,000 that was expected. Okay, so poor Grape didn't get everything as expected. But from a tax standpoint, Grape should be able to at least get all $18,000. So each year, Grape gets $11.25 in cost recovery. So for cost recovery, Grape gets $11.25 per year, right? This number right here, times 10 years. So Grape should get $11,250 of cost recovery, okay? $11,250 of cost recovery. So when Grape receives payment, let's say that Grape dies, let's say Grape gets 10 payments and then dies in year 11, okay, after. So Grape dies in year 11. And let's say that in year 11, Grape gets her final payment. Final payment, okay? Again, it's still not going to get to the $24,000 that was expected. But Grape was able to recover in years 1 through 10, $11,250 of cost recovery. So in year 11, that $1,500 comes in. And you would think, okay, we apply the normal rules. Well, the tax law actually says, and this is good for the taxpayer, that because Grape should get all $18,000, we take the $18,000 cost recovery that Grape should have got minus the $11,250 that was taken in years 1 through 10, and that equals $6,750. So Grape should have received $6,750, an additional $6,750 with respect to cost recovery. Grape didn't get that benefit. So this payment of $1,500 in year 11, the final year, because Grape dies in year 11, what we do is we take the $6,750 that Grape should have gotten benefit, should have got as a benefit, as a tax benefit that reduces these tax payments. Grape should have got that. We subtract the $1,500 payment, the last payment in year 11, and when we subtract that, we get $5,250. So in year 11, Grape gets a deduction of $5,250. Remember I told you that, remember the deduction might play a role here? Grape gets a deduction in year 11 of $5,250. So in years 1 through 10, Grape includes $375. In year 11, Grape gets a deduction of $5,250. There's no inclusion. It's $5,250 deduction. It's an above-the-line deduction, by the way, just so you know. And that's it. And that's it. Because if you add that up, Grape got $18,000 in benefit. Because Grape got $11,250 in benefit in years 1 through 10. And then the final payment is another $1,500. So if you take $11,250 plus $1,500 plus $5,250, you will get $18,000. And that's the idea, is that under this rule, yes, we have a pro rata approach, but Grape needs to get that benefit of $18,000. Because again, the idea is that that $18,000 is what was initially invested, and that should not be taxed. That should not be taxed. What happens if Grape is still alive and receives $1,500 20 years after? So after year 17, once the 16 years are up that are expected, after year 16, after year number 16, 17 onward, we've already recovered all $18,000. There's no more of this portion to recover. It's all recovered. You can't create this initial investment that has a tax benefit from thin air. So every payment, year 17 onward, 17, 18, 19, 20, that portion is going to be fully included. Fully include by Grape the $1,500 for year 17, 18, 19, 20. Assume year 20 is the last year. So year 17 through 20, Grape is going to have $1,500 to include. So let me summarize this again, what's happening. it's really important that we have this life expectancy. Now, this is based on one person's life. If you have joint survivors and whatnot, you know, your spouse, you got to look at that as well. The general rule is we use what's called an exclusion ratio. It's a pro rata approach. An annuity is a portion of costs, what was initially contributed as part of that annuity, and earnings. So here in this example, we have 1125 of the 1500 is considered not taxable, and 375 is taxable. So years 1 through 16, Grape has to include $375. Now, what happens if Grape dies in between years 1 through 16? You got to look at when the death took place and what the last payment is. Here, Grape dies after year 10. So in year 11, Grape gets the last payment in year 11. And then what happens is you look at the cost recovery of the preceding years, years 1 through 10. 11,250 of the 18,000 cost was recovered. So that means that Grape should get an additional $67.50. But there is one more payment, so we subtract it out. So that means that Grape gets a $52.50 deduction, not inclusion, deduction. And then Grape is all done. But what if we change around the facts and say, well, Grape outlives the 16 years? Year 17 and onward, Grape has to fully include that $1,500 payment. There is no more cost recovery because all 18,000, right? All 16 years, remember that's piecemeal, 16 times 1125 equals 18,000. It's all been used up. There's nothing. You can't create more out of thin air. So that means year 17, 18, 19, 20, assuming year 20 is the last payment, Grape has to include 1,500. I mean, you can keep going in years 30, 40. You know, Grape could live to be 102, 103 years old, right? If you look at the actual life expectancy tables, Grape could outlive those life expectancy tables. That could happen. So I hope this helps you understand the idea behind annuities and the rules that apply and the various situations.